Hi folks, Scott here, and this is the wrap for Monday, June 24th. So, interesting day today. Setting up an interesting day tomorrow. We are definitely short-term oversold. Now, the market can remain oversold longer than you can remain solvent, so you got to always keep that in mind, and vice versa. However, we're definitely due for a bounce, and let me show you what I mean. In fact, the data supports it. Different ways of looking at today. We did have an unfilled down gap. We're coming into the end of the month, right? The last week of the month. Both those things are generally bullish, at least in terms of gap fill. But we're really stretched to the downside. Now, different ways to measure this. The one I'm going to show you right now is fading gaps after a 30-day low close. This is actually, I think, somebody in the room says 44 or 45-day low close. Now, I don't want to use that minimum level because that means we'd be looking at all those scenarios that were 40 days and maybe 50, 60, 100, 200 days as well because it's a minimum of 40 days. So I thought it'd be helpful to use, I'll show you the results of fading gaps after at least a 30-day low close, and you're above the 200-day moving average. There you go. Two things should stand out and be very clear to you. One, there's almost more than a 3-to-1 odds of gapping up the next day after you've put in a 30-day low above the 200. That's a decent sample size and worth noting. Secondly, which in my mind is further confirmation that we're short-term oversold, is that the down gaps, again, this is using an end-of-the-day stop, but the down gaps have almost all filled historically, at least by the end of the next session. So, while the up gaps have been more 50-50. Yeah, slight bias. But this is using an end-of-the-day stop, not something I recommend, but it's a great place to start your analysis. And clearly there is a long bias based upon this one particular study going into tomorrow. I think it's a pretty important one to pay attention to. Now, I just showed something else in our trading room. Check this out. Mondays themselves are unique days. I thought it'd be interesting to see what happens if today was a Monday. So I do that by changing day of week for when you would actually trade the gap to Tuesday, which means by definition prior day was a Monday that was a 30-day low close. And go ahead, what do you think happens here while it processes? I bet you didn't think that. There's never been a down gap in 11 years after a 30-day low above a 200. There has never been a single down gap, not one. That's interesting, huh? So now it's a small sample size, but it does totally confirm the long bias. So I told folks this might be an interesting night to look for a long opportunity overnight. I'll check out our worksheet, which I'll post here around 5 o'clock, see what the opening odds are shown there. And then what I normally do is I'll wait until I've gotten the kids to bed and start looking around 10 o'clock Eastern time, 10 to 11. So, and see if I can find a good technical setup overnight. But you never know. I will say this. In 2008, and I don't do many overnight trades. I certainly did none in 2008. But that's when the market got really, really crazy to the downside. I can tell you the overnight moves were outrageous. It would have been very difficult to imagine not getting stopped out. A lot of volatility. So when the market gets weak like this, I think a lot of people get nervous, and it gets easier to run stops. So keep your position size small would be my advice. All right, let's talk about today. Today was sort of a day of good news, bad news, and a little frustration, to be honest. But, you know, that's trading. That's the nature of the beast. And let me explain and show you why. So first things first, look at the worksheet. A gap down. You know, the worksheet's a summation of all the 8 individual gap guides. So at a glance, you can see a down gap below prior lows. 50-50, 54% win rate for fading, but has made money at 1.3 profit factor. That's pretty attractive, and high odds, if it does fill the gap, of hitting the extended target. Basically, by definition, with the way these guides are set up, because we're getting stretched to the downside. Looking at Monday post-options expiration, it's been risky in both directions, though. 50-50 tends to be volatile, and let's see, I'll show you the gap guides super quickly. Hold on. So the gap guys, the ones, so I just averaged up these, the worksheet averages these numbers. So you can see the ES was not terrible. Market condition was favorable in this situation. Down gaps in DL zone. YM more neutral, NASDAQ more neutral, Russell terrible but small sample size. Is that what the yellow means? Looking at the ETFs. Spider actually had a good setup, but not confirmed by the other markets. Dow, 50-50. Q's had a good setup, not confirmed by the markets. Russell again weak. So only 2 out of the 8 met my criteria. Easy to pass on. Overall averages didn't meet my criteria. Additional analysis I did this morning and over the weekend. See, the weekend video wrap, I showed you down gaps on Mondays. Had a decent win rate for finishing profitable, but as I showed members in the trading room, almost half of them, would have stopped you out before they reverse. And I think I mentioned that in the video wrap too. Might want to wait and delay your entry. The gap were large, only 1 of 6 wins. That's what we had today. Down gaps after a 20-day low and closing above the 200. Very high win rate. So that was a positive for buying a down gap. Even sizable ones, and I just loosened the parameters a little bit to keep the sample size decent. Greater than 30% of the 5-day ATR had been attractive. So overall neutral to weak probabilities per the guides. Mixed but mostly positive factors, at least in terms of sample size, right? These 2 big positives there. So 2 ways to play this. Speculative gap fade, greatly reduced position out like a quarter, roughly. Go longer the open, or wait for the range guides, look for longer opportunities after the open. Well, the range guides were added for our members and for me, specifically in part to better trade the bigger gaps. Allows you to buy a little time, get further confirmation based upon the price action after the open. So considering today was Monday, Mondays tend to be risky. I said I will do the latter, which is wait for the range guides. That's what I did. That ended up being a great decision because the market sold off significantly. In fact, about 15 points in the ES up there right here, which would have stopped you out. So great call, great decision to pass on the gap. The data clearly showed there's some clear risk. 15-minute range guides came out. Unfortunately, they did not favor the high side, nor did the first hour. They were slightly favorable, I should say, but they weren't compelling. And I think they all would have worked today, actually. They triggered late afternoon. But they just weren't quite clean enough and compelling for me, and they didn't trigger this morning, which is when I spend the bulk of my time watching the markets. However, they did favor the low side. Let me show you those real quickly. So I've got a long bias, right, based upon my pre-market comments. But today was a little bit unusual in that the low breakout was strongly favored on the 15-minute and first hour guides. Look at these numbers. I'm looking for 55 and 1.1, by the way. My standards are a little bit lower in these range guides because they're less correlated than my gap analysis from the gap guides. Check, check, check. I mean, these are clearly meeting my minimum criteria. That's all 4 checks there. ETFs, check, check. Neutral or slightly positive, leans that way. Check. 7 of 8 clearly met my criteria. So I was in a situation where I had a long bias. I clearly talked about that in the trading room ad nauseum. But the data was showing the short-term technicals, which is really what those range guides are. The gap guides I created have more market condition specific information built into them. Tim created the range guides with my help, but we did not include as much market condition information because I've been planning on for a while to. Actually, at the time we created them, I'm not sure this is a consideration. We just didn't. But we are planning on rolling out some macro or what I call big market condition data that will help better trade the gap and range stuff. And it would have helped today. That was part of my quandary. The short-term technicals were compelling. They were so compelling I had to trade it. I cannot pass when the data has 7 of 8 or 8 of 8. If I do, I'm breaking my trading plan. So I had to put some skin in the game, and I wasn't totally sold that it was a terrible trade because I thought we may get a quick hit. So I didn't want to risk much, though. So I want to use the smallest position possible. So instead of trading all and splitting my money between the ES and the Russell, I decided to only trade the Russell. Well, the Russell on the 15-minute was the last to trigger. And you can't tell that. But if there's one takeaway today, I think there's a rule that I'm going to start thinking about seriously. And that is, don't be the first to the party or the last to the party. So the Russell triggered, watch these lines there. You can see where everything else was trading. Everything else had already triggered, and YM had already even hit its stop. So it was the last one to trigger. Well, it triggered, reversed, stopped me out. Then the first hour guides came out. I decided, well, don't like that action. That shows how bullish the Russell is acting, and the ES is acting really weak. So I'll trade the ES. I generally don't trade NASDAQ and Dow. They're okay, just not my preferences. Well, as luck would have it, ES triggered the first hour here. It was the only one to trigger at that time. In fact, I let it triggered, bounced, and I said, well, I'm not going to take it because it looks like it could be a fake out. If it rolls over and triggers again, I will take it because it actually triggered on the first bar. Well, it did roll over, triggered, sucked me in, and I got stopped on that. So I had this bull buyers, picked absolutely the wrong markets. I picked both markets in the Russell. Well, I guess I would have stopped out both in the Russell. But I missed the ES. The bottom line is the ES worked. That was a little frustrating. It would have been basically a scratch trade, but frogs had wings; they could fly, and so on. Anyhow, the good news is I avoided the losing gap and I greatly reduced my position size on these range trades. Bad news is, and I followed my plan, but I still lost money, and that's frustrating. End of the day, gotcha did not set up, so nothing there. It was too close to the open. So, all in all, a marginal day. A little bit tough to lose money when you have a long bias, but that's called trading. And again, could have been a lot worse. So, there you go. That is the wrap for Monday, June 24th.